the 24th of November. I am Bosin Amafaye, and this is your Frontier Opening Bell for today with Ali Khan Sachu, the CEO and founder of Rich Frontiers Management in Nairobi, Luke Ofojebe, who is in charge of equities analysis at Betiva Capital Management, and of course, Ayo and Luke, who is a senior economist and head of strategy and research at Greenwich Merchant Bank. Thank you, gentlemen, for making today's show. Let's hit the ground running. South Africa's stock market yesterday escaped the knock-on effect of the double downgrade that it got on Friday from Moody's, and Fitch ratings went up nearly 1%. The currency, the rand, however, nosedived slightly, 15.44 at the end of Monday. The Kenya market flattened out. Egyptian market about 0.25% in the green territory. Ivory Coast was much bigger than the rest of his peers, 1.16% for the BRVM, but Nigeria softened 0.04%. Again, the banking sector led the market down nearly 3%. The morning after, Nigeria reported a 3.6% negative GDP reading for the year, for the third quarter. Let's go to the East African market, and Ali is bringing us up to speed some of the big stories from the National Treasury. The whole story around whether Kenya is asking for a debt approachment from the IMF or from the G20, what further funds it needs. Bring us up to speed very quickly on this, then we can add the diaspora remittances story to that.
So there's been a lot of confusion in the media. I mean, it started off with this report that Kenya was looking to participate in the G20 interest and debt moratorium, which was then rebutted by the National Treasury. The National Treasury then pronounced that they were looking for two loans, one of $2.3 billion from the IMF and another loan from the World Bank as well. The National Treasury also pronounced that they expect GDP expansion to be around 1% this year. So it's, there's been a lot of news, but it's still, and then today Business Daily was headlining that Kenya was applying for debt relief from its primary creditors as well, and Business Daily has been leading with this headline, Broke Kenya, which seems to be their favorite headline of late. So there are issues around the debt profile. There has been a big squeeze. Obviously, revenues are down. Expenditure has not been trimmed. It's been increased. And the question is, how is the government going to square the circle? There's a lot of skepticism about how that will be done. I think, if the IMF and the World Bank give Kenya the loans that they're requesting, then Kenya can kick the can down the road. Otherwise, we're going to have to see some much more dramatic action, particularly on the expenditure front. Your other headline was about remittances increasing 17.3%. This is a miraculous outcome. The World Bank and the IMF were predicting a remittance slump of between 10 and 25%. And interestingly, remittances in Kenya have always been very counterintuitive and performed very well in scenarios where the world is in recession. So this is a very good outcome, and it's helping the shilling to some extent, which has been coming under a lot of pressure of late and has been hitting record lows. Interbank is just above 110. And if I can touch on two of your headlines, Carbacid, profit after tax up 23%. There are very few companies in the world that are able to deliver profits, double-digit profit increases. And they're basically in the storage game, cold storage, that kind of thing. And obviously there's a bigger demand, and people are anticipating even bigger demand with the vaccine rollout that is expected early next year. Tea auction prices increasing slightly. Tea prices have been quite suppressed because we've had a huge production this year. But for tea companies themselves, of which there are a few at the Nairobi Stock Exchange, they've done well with a weaker shilling, which has offset the lower price.
May I get an additional free cup of tea?
Yes, the best thing is, as
Send
Boris said.
it over. Send
Yes.
send it over, Ali. Thank you very much. Each time I had the opportunity of coming to Nairobi or Rwanda, I love the East African tea, by the way. Very good product there. Well done, folks. Let's talk about the Nigerian market. And of course, today is the big day for the interest rate decision by the central bank. What to expect? Hold, cut, or raise? Well, we'll have until about 2:30 in the afternoon to find out from Godwin Emefiele and the rest of his team. Third quarter GDP negative reading triggers sell-off in the banking sector. Then you have Nigerian breweries reporting 234 billion naira net revenue for 9 months ended September. Operating profit 22.6 billion. Ghana kept interest rate unchanged, 14.5%. And in Côte d'Ivoire, the Bank for Trade, called the BICICI in French, says its net income was up a whopping 569%, about 4.7 billion CFA franc in the first half of the year. Let me start with Ayo Dijebo, who is a senior economist. About it looks like a bit of a consensus from all of you analysts and research firms that this third quarter GDP was a recession, but a bit of a recovery from where we're coming from. Give us a minute on that, Ayo.
Yes, it was very clear and very obvious based on even some of the leading indicators that we're going to record a negative growth, which will confirm that the economy is in recession. But it's also interesting to look at it from the perspective of comparing Q3 to Q2. So you would see that improvement from about 6% in Q2 in the second quarter to about 3.2% in Q3. But if we look at the oil sector, which we that accounted for or dragged the growth, especially for the oil and gas sector, you would notice that we're not also expecting any major improvement in that space. It's largely tied to the OPEC quota. So when you look at it on a year-on-year basis, we're not expected to produce as much as last year. So that will still remain in the negative region. But the other sectors that should also call for concern that we need to look at is trade. We are looking at it based on the employment it generates. We need to look at those policies that would help improve activity within that space. The FX policy may need to be tweaked to support activities within that space. And looking at the manufacturing sector, there needs to be some form of support, maybe a national developmental plan that we can follow, that lasts beyond one government, that would follow to see how we want to improve activity within that space. Most job elastic sectors needs to be focused on so that we can take care of our insecurity issues in Nigeria to attract foreign direct investments.
Okay, great. Thank you so much. So what happened was that the market seemed to react to that. This market seemed to react to that yesterday. Luke, what's your take on that? When the banking sector fell yesterday, was that a direct consequence of that? We saw earnings from First Bank or FBN Holdings just over the weekend. Then Unity Bank also reported, but surprisingly, the banking sector dragged the overall equities market despite big gains by MTN, Dangote Cement, Dangote Sugar.
Yeah, so like you rightly said, the banking sector was down significantly, lost about 5% yesterday. So that was mainly due to negative sentiment on the banking sector, which was largely due to the unimpressive GDP data we saw. We saw another contraction in the third quarter. However, comparing to what we saw in the second quarter, that was an improvement. I mean, the contraction slowed from 6% in the second quarter to 3.6% in the third quarter. So what do we expect going forward in the stock market as a result of this? I mean, right now, investors want to be cautious. We understand that some of these banks that closed down yesterday significantly, some of them actually released better than expected results. We saw growth in their gross earnings as well as their bottom line. Not just growth, we saw the quality of their earnings improved. Say for Access Bank, where the bottom line was mainly supported by the significant gains we saw in non-interest income. For the other banks, the quality of earnings actually improved, and we do expect that to manifest in the fourth quarter as well. However, going into 2021, we are a bit worried about the performance of these banks because interest rates currently low. And at the MPC meeting today, we expect that they will keep interest rates unchanged. If at all there will be any change, it will be to cut the rate further due to the fact that the economy is already in a recession. So they want to do everything possible to spur the quick recovery of the economy. So we expect rates on that basis to remain low for these banks. So the best bet for them is to aggressively grow loans. And at the same time, we understand that the economy is still not in a very good position right now. So aggressively growing loans could backfire in the long run. We might start seeing high rates of loan defaults. So on that basis, we do expect interest income from loans to drop, interest income from investment securities due to the low rates in the fixed income space to also drop. Then non-interest income, which has supported some banks, we do not expect growth to be coming from that item significantly. So next year, we're a bit skeptical about the performance of these banks next year. However, for the companies in the REIT sector, we do believe that the continual realization of social distancing measures will continue to support their growth. Like you mentioned earlier at the start of this meeting, you mentioned the significant growth in Nigerian breweries and other manufacturing companies. I mean, that's expected really, given the fact that the lockdown is no longer as strict as it was in the second quarter, and we expect measures to continue to be relaxed continually. So that should definitely support their revenue going forward. It should also support their margins as well as their bottom line. So for these ones, I do expect that we might see continued positive sentiments on some of these fundamentally sound companies in the REIT sector. I would like to mention an example here, which is Flour Mill. We understand that since the government decided to close the land borders in September last year, we've been seeing significant growth in their top line, mainly driven by local demand being channeled to the company. So we do expect that to continue. We expect the trend to continue next year. So we do expect significant growth from the likes of Flour Mill. So on that basis, we expect sentiment on companies in the manufacturing space to improve going forward. Then in terms of the overall expectation, the banking stocks are still a major driver of sentiments in the market. And when you see sentiments on these stocks negative, it's in a way filters across the entire market and you start seeing negative sentiments on other counters. So overall, we expect that this negative sentiment could persist for a while, and then maybe by the end of this month slash early December, we start seeing a renewed buy side sentiment, and by the end of the year, we see more of portfolio rebalancing, and that would definitely lift market sentiment again. Thank you.
Thank you, gentlemen. We're going to touch on one very important issue for all of you, our panelists this morning, our contributors, regarding the fiscal balance and the fiscal space for a number of African sovereigns. Ali touched on Kenya a little bit on about the debt relief and further request from the IMF. Yesterday, the news out of Ghana was that the country's debt to GDP is now 71.0%. That's something. That now puts Ghana's total public debt at 48 billion US dollars. Nigeria is about 83 billion dollars. That's about double that figure, and a notch of that. So now, when you look at South Africa, now let's talk about Southern Africa now, about the double downgrade into further junk territory by Moody's and Fitch ratings and all the talk about how South Africa would move on. Some of the analysts in Southern Africa says the banking sector in South Africa will not see much impact from this downgrade. There will be very limited impact. Some good news on the business front because British Airways is reopening routes into South Africa, 15 aircraft ready to take off in the first week of December. Prosus and Naspers in share buyback and numbers being reported by Naspers, 4.2% drop in half-year headline earnings per share. Pepco retailer reporting 34% drop in annual profit. All of this about the business sector, but we'll talk about the fiscal space. And that's where I want you gentlemen to speak to the issue. While Egypt looks like the poster boy up north of the continent, here is Kenya, Nigeria, Ghana, and we spoke with the chairman of the Nigeria Economic Summit Group last night, and he says Nigeria's fiscal position is quote-unquote very delicate at the moment. So these are very troubling situation and reports that we're getting across board. Ali, let's start with you.
Yes, so I think you're completely correct. The problem is not only the optics of the debt to GDP position, it's really the interest payments that have to be made in order to service that debt. And the amount of revenue that the government is collecting, which they're having to allocate to debt service. And if you look at that, most countries are at extreme levels. And this applies in Kenya, where something like 40% of all the revenue being collected is going into debt payments, into interest payments, and you've got even higher numbers elsewhere. And I think that is the single biggest challenge for us on right now for these countries. And that's why you had that G20 initiative. A lot of countries, Kenya included, are not keen to go into that G20 arrangement because they feel it will constrain them from going back to the Eurobond market. We learned that Ivory Coast is probably going to issue a euro-denominated Eurobond. It's likely that Ghana will as well. But ultimately, I think, even if they go for these issues, it just means the problem is sent further down the road. The problem, in my view, for most countries is the cost of government, the recurrent expenditure component of the budget, which I think is too high, and then the return on investments made with the borrowed money, which in many cases is negative. I mean, take Kenya, for example, who borrowed heavily from China. The railway is not producing a positive return. It's actually costing money every month. And I think those are the real challenges. They pretty much apply from east to west, as far as I can see.
Ayo, what's your take on this?
Firstly, I think it's a major cause for concern. And I was speaking from the perspective of Nigeria. We've continued to accumulate this debt and without any clear view of how to repay. So it's like kicking the can down the road. You try to reissue and you want to solve the current problem. Yes, it's good to solve this current problem, but also thinking about the future. Yes, for most of the countries, because they have the ability to also reprint, print money for them to be able to pay back. But it's getting to a level when we begin to match the revenue compared to the amount of debt, the debt servicing. So you look at, for instance, the situation of Nigeria based on the budget office data. In the first quarter, about 99% of the revenue they made was actually used to service the debt. So that is a major concern. And most times, if we don't begin to view countries or economy as like a private business, how would you have run your own business? You discover that the total revenue you are generating is used to pay debt. Then how would that economy be sustained? How do we grow? And beyond even the issue of repaying those debts, there are major issues that all this leads to. So if you are not investing in most of those productive sectors that will create jobs, then the economy or the country may not be um, habitable for even the few individuals because insecurity would be high. So looking at it from the perspective of that default, yes, for the naira or for the domestic currency type instruments may be difficult to default because they can always print money. But where the concern would be if they are raising um, debt in other currencies like the euro bond, for instance. We will be looking at it vis-a-vis our expected revenue. But there needs to be a deliberate effort to reduce the amount of borrowings that will be channeled into the non-productive sectors. Looking at our proposed budget, for instance, about 13 trillion, you look at the recurrent expenditure, it's almost about 10 trillion by the time you had both non-debt and debt, non-recurring and recurring debt. You will see that it's almost 10 trillion. That is not sustainable. 30% of that is for personnel costs. It's not going to take us far, and it's we're just uh, pushing the can down the road, and this would still have its would there will be a backlash as if we continue in this pace. We saw, and just to wrap up with, for most African countries, the problems are almost general across. We rely on maybe one or two single commodities for us to run the government. Things cannot work that cannot be sustained that way. So we need some form of diversification in terms of the revenues that we generate. And we have enough resources. Yeah, we'll be looking at how the after that's the African Continental Trade Free Trade Zone kicking off in January. How do we, as as a continent, how do we take advantage of that? How do we reposition most of our companies that we can, manufacturing companies that we can export or whether import from those countries, such that we build a capacity that will reduce our borrowing. We're able to generate internally generated revenue that will be able to sustain our economies and reduce
Well
those
said.
fluctuations that we get when some of those commodity prices go down.
Well said, Ayodeji. Look, to wrap up for us on this particular issue, do you think the private sector uh, has what it takes to support the government at any levels, or do you think they have what it takes?
Um, they have the potential to really support the government significantly, but the government also needs to meet them halfway. And meeting them halfway is having an environment that enables increase in investments, increase in investments in capital infrastructure, in human capital as well. So speaking on this debt to GDP, when we quote debt to GDP figures, for me, I'm not always that worried because when you look at the US, for instance, debt to GDP is about 98%. In the UK, it's about 85%. The major problem we have in Nigeria and in other African countries is actually the inefficient use of resources. There is nothing wrong with raising debt. Clearly, as a developing economy, the early start of your growth, you always be having budget deficit. So you always need to raise debt to finance this deficit. So if you pick Ghana, for instance, an economy before COVID-19 was growing at the rate of 5%. If they raised additional debts to build infrastructures and the likes, and the economy grows the next year by 7%, the following year by 8%, because it's a developing economy, there is more room for growth compared to an advanced economy. For the US, the highest level of growth you will see is 2%, 3% at most. But for developing economies, you see them growing at the rate of 5%, 8%, 10% sometimes. It's because they have a large room for growth. And the only way they can actually get to this level of growth is to raise debt to finance their budget deficits, and that's what we should be doing in Nigeria as well. But the problem here in Nigeria is the inefficient use of these resources. We raise these debts. What do? We will subsidize consumption. Corruption also has its own way. There are leakages in some places. We are talking about a country where you pay up to 200,000 naira just to make a uniform for a customs official. I mean, so if we can clear all these leakages out of the way and actually spend these borrowings on what we are meant to do, on road infrastructure, on power, on education, I mean, you cannot grow beyond the level of your education. That's a rule of thumb. Look at the level of education in Nigeria. Look at the young Nigerians leaving Nigerian universities every year. Meet these private employers. They will tell you that a number of these people are not employable. People that cannot write cover letters, that cannot use Excel. And it's not really their fault because that's the environment they are exposed to. Where you are talking about a nation where the human capital is not even developed. How do you want to grow? So these are things that the government needs to address. And like I mentioned at the start of this program, I told you that one of the major problems we have here is not having visionaries as leaders. Until we begin to have visionaries as leaders, we will not be able to take the right steps. We can analyze the economy from now to tomorrow. If we don't have visionaries, people who really want to take this country forward, we'll keep having these leakages in terms of managing resources. So the debt to GDP shouldn't be worrisome. It's what do we do with this debt? So until we get it right, I think we might just be at this situation of always talking about debt sustainability, what's going to happen in the next 5 years, in the next 10 years. In the next 10 years, the government is going to raise more debt because that's the reality for us. The demand for crude, which is our mainstay, is falling. We're already seeing companies that are involved in use of renewable energy. We are seeing electric cars in advanced countries. The demand for oil is already falling. It's not going to improve in the next 10 years. So what's the government doing right now in terms of diversifying the economy? Yes, we see agriculture, we see the anchor borrowers program, they are supporting farmers. Drill down, evaluate the anchor borrowers program. Look at what the government is doing. The government is mainly focused on the number of beneficiaries and not on the quality of beneficiaries, just because you want to support your political goodwill. And that shouldn't be. A number of these farmers that they are supporting cannot really drive long-term high growth in the agri space. If you are just going to support like 10 farmers who are going to give us 10% growth in agri, support these 10 farmers. You don't need to support all the farmers in Nigeria because you want to take attendance. That's not what we should be doing. So the government needs to really address these issues the way they should. And until then, we might just continue to have this issue of, oh, debt is rising. Next 10 years, what's going to happen? Next 10 years, we will raise more debt because that's the reality for us. We cannot manufacture money. We need to raise debt to finance our budget deficit.
We can't manufacture money. Even the currency, local currency that you print, you know, if you think you're manufacturing it, you're wrong. Because
inflation will erode everything. You can't continue to print money. Inflation will erode everything.
You can't manufacture money. The best way to manufacture money is to generate it rather than print it. Ali's smiling over there. I'm sure you agree.
I completely agree, and I think what Luke was very passionate, and it's very frustrating because sometimes I feel our policymakers are on a different planet. They don't, you know, we're sitting there, we can see the train coming towards us, we have all the human capital, we have all the human resources, we can see how it's being done in other parts of the world, in Asia, and I just feel that, you know, we're not serious. And that's what worries me. And I'm just wondering, where is that generation of policymakers who are going to come in and say, guys, it's not working. Let's switch and let's work out how we can make it work. And there is no hanging fruit. I agree with Luke. And if we continue down this road, I don't know what will happen.
I agree with you. I agree with all of you completely. Thank you so much for your thoughts this morning. Just to touch it up on a final note, I'll run through the North African market space very quickly with a touch on e-commerce in Egypt. Expand chart, $2.5 million Series A funding round. Orange is investing additional £4 billion, Egyptian pounds, that is, in this network upgrade for the country for 2021. That's big business. You can't go wrong with data and telecommunications right now. Cairo Oils is looking at a stock split from £5 previous, and Bank of Africa in Morocco says its net income went down 16%, 1.24 billion dirhams in the period to September. That's Substitute for this morning. Thank you so much, everyone. Ali Kansachu in Nairobi, thank you so much from Frontier Management. Adi Jebo from Greenwich Merchant Bank, and Luke Ofojebe from Vertiva Capital. Thank you, three of you. We appreciate your incisive comments this morning. Let's leave it there today. We'll get back tomorrow, Wednesday. Bye for now, everyone.